Welcome back, everybody. Chevron posting quarterly earnings that were right in line with the street's expectations. However, that stock is trading a little lower this morning. It's down by about 2.7%. The company's been dealing with weakness in downstream volume, also refining margins as a result of the pandemic and that major winter storm that hit Texas and other areas of the country so hard. Joining us right now is Pierre Breber. He's Chevron CFO. And Pierre, thank you for being with us today. Let's talk a little bit about what that winter storm impact meant and where the company stands right now.
Yeah, well, thanks, Becky. I mean, first, I'd say it was our strongest quarter since the pandemic, highest earnings and cash flow, some exciting announcements in low carbon businesses. We announced a dividend increase and we kept a strong balance sheet. Winter Storm Uri did impact our results about $300 million after tax. But we've got all the production operations back up and running, all our major refining and petrochemical units. And what Uri really did is tightened inventories and margins are higher. So as we look forward, our cash generation should be even better going forward with oil prices greater than $60 at Brent prices. And again, these much stronger refining and chemical margins.
Are you kind of counting on oil prices staying at these high levels, if not moving beyond this? I mean, we were all pretty shocked by what happened just over a year ago when oil prices actually went negative. But we've seen the globe start to reopen. We've seen oil prices run up and stay up. What's your expectations about what we should expect to see maybe for the remainder of this year when it comes to oil prices?
Yeah, we're not any better at predicting oil prices than anyone else. We're not counting on higher oil prices. We showed during our investor day that at $50 Brent, we could grow free cash flow more than 10% a year over the next 5 years. So that gives you confidence that we have the capability to grow the dividend at really good rates going forward, not just the 4% we saw this year or the 8% we saw last year. In terms of the macro, we've seen gasoline and diesel really back to pre-COVID levels. Jet fuel is poised for a comeback. Certainly, we expect it domestically here in the U.S. as the vaccination rates are up. And we've seen that in other countries that have gotten control of the virus. And the last leg, which we think will follow soon after, is really international travel. So we're optimistic here in this country with high rates of vaccination and the stimulus package. Other countries have control of the virus. Of course, others don't. And so it's not still, we're not yet on a path of a sustained global economic recovery.
You know, part of what we saw, it was you and other big energy companies really cut back on capital expenditures as a way to react quickly when oil prices plummeted. What plans do you have in terms of spending right now? What can we anticipate over the next year and over the next several years?
We're going to deliver our budget this year, which is $14 billion. There's no change in that. Our guidance for the next 5 years is in a very tight range, $14 to $16 billion. We're going to look at three conditions, which we've been talking about since the start of the pandemic. The first is a sustained global economic recovery. Again, reason for optimism here, but not yet across the whole globe. The second is clarity on what OPEC Plus actions are going to be and seeing more of those barrels coming into the market. We're seeing that start. And the third is inventory levels. Those are actually in line now. So that condition is largely met. We started about a year ago. You were talking earlier about negative oil prices. Inventories were very high. Over the past 12 months, they've worked down into a normal range. So that's all within a very narrow range, though, between $14 and $16 billion. Last thing I'll say is we're not just going to look to the commodity markets. We're going to look to the equity markets for a signal to increase capital. And that signal has not yet come from the equity markets.
What do you mean? The equity markets, meaning investors will reward you for spending more on CapEx? Or is there some other signal you're looking for? Yeah,
Becky. I mean, look, we're one of the few sectors that's trading lower post-COVID than pre-COVID in a market that's up. So we need to be disciplined with our capital. That's true in our conventional business. That's true in M&A. And you've seen that when we walked away from the Anadarko transaction and when we did the Noble Energy transaction last summer. And that's true with our energy transition activities. So we have to earn the right to invest more capital. We're going to be very disciplined with our capital. Our message to investors is very simple: higher returns, lower carbon. We have to do that by being very disciplined with our capital.
You mentioned Noble Energy and that acquisition. You paid $12.1 billion in cash and stock last year for Noble. Just looking, worldwide net oil equivalent production was down by about 4% for you all this year, but that's because of a decline in international. In the U.S., your output was up by 210,000 barrels a day, in large part because of that Noble Energy acquisition. What else can you tell us about the acquisition and how things are working, where things are coming together and where there's overlap?
It's going great. I mean, we were the first to announce a transaction in July. not, only a few months after that famous day when oil prices were negative. We were the first to close in October. We have 2 quarters having integrated. We doubled our synergy estimate from $300 million to $600 million. We've achieved already 80% of that. We expect to achieve the rest before the end of the year. And you can see in our production numbers and our reserve numbers that this transaction that was, I think, very good when we announced it has only gotten better.
Pierre, your stock's down by about 2.5% this morning. Why do you think that is? What do you think the street heard that it didn't like in the numbers?
Well, look, we can't control the stock price. We're managing this business for long-term value. A dividend increase of 4% shows the confidence that we have going forward. An average dividend increase of 6% the last 2 years during a very difficult time. Free cash flow growth of 10% a year over the next 5 years at low $50 Brent oil prices, the ability to generate excess cash if oil prices are higher, recovering chemicals and refining margins. So we're confident about the future.
Shepard Smith here. Thanks for watching CNBC on YouTube.